Hey guys, hope you're doing well out there. The last time we took a look at shares of Shopify, they were closer to $77 with a market cap near 115 billion. Now in the after hours, we're taking a look at shares of Shopify sub $60 with a market cap also south of $80 billion. So the question has to be asked, is it finally time to step in and pick up shares of this one? The last time also, nearly 2 months ago, we outlined a buy zone for this company where I think it would make some sense to step in and at least start a position somewhere between the $51 to $58 a share in the after hours. Like I said, closer to $59. This one is awfully close to that buy area that we outlined. So again, we'll ask the question from a technical perspective, are shares of Shopify entering an area where it would make sense to step in and pick this one up as a long-term buy and hold? We'll look to answer that question and a lot more in this video. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Shopify, after reporting their Q1 report earlier in the week, looking like a waterfall as you have shares down nearly 20%. That is just over the last 5 days. And part of that is for good reason. You still have nearly a $76 billion valuation on this company, despite that 20% drawdown just this week alone. And that comes on the heels of their Q1 report with revenues of $1.86 billion. That was good of roughly 23% growth on a year-over-year basis. So keep in mind, this company is still posting strong top-line growth, and that 23% growth does account for nearly a 6% headwind from the sale of Shopify's logistic business. So if you just look at organic revenue growth, this company is growing somewhere closer to 29%. So you're still getting a company with phenomenal top-line growth, and that just simply can't be questioned. Now, that was a small beat of roughly $10 million according to Wall Street estimates, and I would actually consider that more to be in line. On top of that, Q1 non-GAAP EPS came in at 20 cents. Again, a very small beat compared to what Wall Street had as their estimate, closer to 23 cents. And when you have a gigantic, nearly $80 billion market cap before this earnings, a nearly $100 billion market cap, and you come essentially in line on your earnings and revenues, simply not good enough for Shopify. When you have expectations so high, you have to come in and deliver. On top of that, what I really think sent shares down was their Q2 guidance. As revenue guidance for the upcoming quarter, Shopify is saying for the high teens percentage rate, and estimates on Wall Street were closer to 19.73%. So again, when you come in line with your previous quarter's revenues and earnings, and then on top of that, you don't come in and raise your Q2 guidance, that's a recipe for disaster, especially when you have a valuation north of 60, 70 times a forward priced earnings at nearly 80 to $100 billion market cap. Again, you have expectations so high, you have to come in and deliver. And Shopify simply just came in with the bare minimum. On top of that, Shopify also guiding for gross margin in the upcoming quarter to decrease roughly 0.5% quarter over quarter. Not a big deal, I think, year over year. They'll still see an increase on their gross margins, but you are seeing quarter over quarter a decline, maybe saying that Shopify's gross margins topping out in this Q1, possibly for the year. And so that is, again, something to just consider, the fact you have a large valuation and gross margins will be declining on a sequential basis. In terms of other things Shopify guided for, they're expecting GAAP operating expense to be up low, mid single digits on a year over year percent. Again, it's not something to be overly concerned about when we take a look at their financials. This company still on the turning point towards profitability, and they have right-sized their business to a large extent. You still are expecting roughly $120 million in stock-based compensation for the upcoming quarter. And when we take a look at their cash flows, this company, while the stock-based compensation isn't as egregious as it was earlier, still a large number when you consider just how much earnings this company prints to their bottom line. Also on top of that, expecting roughly $5 million in CapEx, a very CapEx light business. So that's something good to see. You have nearly all of your operating cash flows translate to your free cash flow dollars. And then on top of that, Shopify guiding for free cash flow margins roughly at 12%. That's another strong number, at least compared to Shopify's past. So in terms of Q2 guidance, you have some things not to like, as they didn't guide for that revenue growth to be north of 20%. I think that's really what would have kept shares at least on par. They're expecting roughly high teens. That could be 17, 18% growth. And in my opinion, a disappointment to what Wall Street had. And speaking of that, Wall Street did lower their estimates for the upcoming Q2, at least on that revenue side, now expecting revenue growth somewhere between 18.35% instead of a number closer to 20%. Keep in mind, in the long term, do I think if Shopify grows at 18.5% compared to 19.5%, is that a huge deal? Probably not over the long term, but certainly over the short term, when you have a gigantic valuation and you don't meet up for that, yeah, you will see large swings in your stock price. And then in terms of an earnings growth perspective, this company is still expected close to 50% growth in the upcoming quarter, strong number. And then as we look ahead to the subsequent quarters, that growth on the earnings side is expected to subside. But if you have a longer term outlook for a stock like this, you have to realize this is a company that's expected to double their earnings, call it in the next 3 to 4 years, going from $1 up to $2.12 just over the next 3 years. And then on the revenue side, similar story, expected to double their revenues from $8.5 billion all the way up to, call it $18.5 billion over the next 4 years. So without a doubt, this company is still a high growth company with revenue growth north of 25% on a year over year basis, nearly for the next 4 to 5 years. And then similarly, if you can control those operating expenses and continue to grow your two main businesses over at Shopify, yeah, this company from an earnings perspective, again, looking to double that earnings on a 3-year basis. And so while you're still paying a expensive valuation today, with the growth of those earnings, that valuation is expected to come down. And so the important thing to know about a stock like this is you want to pick it up at the right point, at the right valuation. So you're really not overpaying for a stock today, even though you're expecting growth in the future. You want to pick it up at the right price, despite having phenomenal growth in front of it. Now, Shopify does have two main business units, the first one being subscription solutions, and then you have your merchant solutions as your other main revenue driver. And so subscriptions is the business where you have a monthly recurring or even annually recurring revenues. This is your software-like business, phenomenal margins. As you saw, revenue growth on this business unit closer to 34%, with revenues coming at $511 million. And the best part about that is it's an extremely high gross margin business, as it costs you just $95 million to generate roughly $500 million. So you're looking at gross margins north of 80%. In fact, year over year, you expanded your gross margins on that business as well. So despite it being a smaller revenue segment over at Shopify, the fact that you're growing this at close to 34% faster than your overall Shopify revenues, and it is a higher margin business, that is part of your bull case over at Shopify, frankly, that one day, maybe you expect these subscription solution revenues to come in and at least equal, if not surpass, your merchant solutions revenue. And so that is part of your bull case, the fact that this is such a high margin business growing at such a fast clip. Now, you still do have the bread and butter over at Shopify, which is the merchant solutions. The majority of this company's revenues still coming from this business unit, still growing at a pretty fast clip, north of 20%. So not like you're sneezing at the growth on their merchant solutions business up to $1.35 billion, but you do have the gross margins on this business not nearly as beautiful as your subscription solutions, as you're looking at a business close to 40% gross margins. Now, I've said this before, having nearly a 40% gross margin business as your main business and then an 80% gross margin business as a side business, yeah, that's a phenomenal business model. A lot of companies would honestly die to have a 80% gross margin side business. And so if Shopify is doing that and continuing to grow it, I think that's still a recipe for success. And so you have up to $957 million in gross profit. That is up from same time last year at $717 million. Keep in mind, this company is still at north of $80 billion from a market cap. So you're looking at roughly $4 billion annualized in terms of gross profit over at Shopify. And like we said, $80 billion, that puts you at nearly a 20 times gross profit multiple. Yeah, not an earnings multiple, but at a gross profit multiple. And so still a very expensive valuation for this company. And the reason we keep coming back to the valuation for Shopify is really that's my only knock against this company. Look, we see the revenue growth is phenomenal. We see they're growing a higher margin business at a faster rate. We see they still have growth on their nearly 40% gross margin business. And so the growth rates over at Shopify look phenomenal, but you have to consider all of that comes in the context of a gigantic valuation. And no matter how good a business is, there's always a price where you can overpay for it. And so despite these earnings and results being fantastic, you're still overpaying, in my opinion, for a stock at close to $60 a share. Now, your gross profit line isn't the full story over at Shopify. You do have operating expenses, in fact, quite a bit of them. And so your sales and marketing did tick up to $360 million. That is up from same time last year at $290 million. So a substantial tick up, I would say, on your sales and marketing, something Shopify does still have to, in my opinion, pull back on just a little bit. But certainly if they do pull back too much, you might see a slowdown in their top line growth. They did pull back on their R&D as that went down from 335. Previously, we were sitting closer to $450 million on your R&D. G&A also staying in line at roughly $125 million. And then you have a small $50 million expense on transaction and loan losses. And this is a part of the business I think Shopify relatively new in, where they're extending lines of credits and loans to the small businesses running on Shopify. And frankly, in my opinion, probably a good business model, considering Shopify has pretty good outlook and pretty good insights into how much revenues and earnings their businesses, at least their small businesses, are doing. And so if Shopify can extend a bit of a loan to them at some sort of an interest rate and look to repay that loan from maybe a cut of the revenues from those Shopify stores, probably a pretty good business model, one where they probably won't take too many transaction and loan losses simply because they have a ton of data on how those small businesses are doing. And so we combine all of that, and we're looking at roughly $870 million in operating expenses, staying roughly in line to flat, slightly down on a year-over-year basis. And so growing our gross profit and keeping our operating expenses in check, that allowed Shopify to turn from an operating loss of roughly $190 million same time last year to an operating income of close to $90 million. And we saw this last quarter, this company turned around from an operating loss to an operating income. Seems like that is continuing. Now, in this most recent quarter, they did still experience a one-time, nearly $340 million one-time expense. And so that will turn around their net income to a net loss once again to the tune of close to $273 million. Seems like same time last year, they experienced a one-time income benefit of roughly $270 million. So in my opinion, I would actually more so consider the operating income over at Shopify. The fact that they've turned this around seems to be a good sign. The fact that they've controlled those expenses while continuing to scale revenues. This company, as you can tell, at one point was frankly far too bloated from a cost perspective. And so the fact that they've trimmed down nearly 20% of the company, certainly a tough decision, but in my opinion, a good one over at Shopify. Now, because of that one-time expense, you do have a net loss on an EPS basis close to 21 cents a share. But like I said, this is a one-time expense. I would pay more attention to their operating income. Certainly, you wouldn't want to see this slide back into an operating loss and have those operating losses accelerate. The other thing you have with Shopify is continued share dilution. And so when you take a look at the stock at an expensive valuation at a high price, there's really no reason to even come in and buy and hold onto shares, as you're getting not just a expensive stock, but one that is diluting you. In fact, not doing buybacks, not paying a dividend. And so there's really no long-term benefit in holding shares of Shopify at an expensive valuation. The only way to make money on this stock, at least as of now, is to see it through capital appreciation. And so it's super important. In fact, that makes it more important to pick this one up at the right price, because you don't get a dividend and you don't even get a buyback. From their balance sheet, really nothing to worry about, as you're sitting on roughly $1.6 billion in cash and cash equivalents, another $3.5 billion in marketable securities. So you're all cash and short-term investments coming in north of $5 billion. And this is a company with not a whole lot of debt. In fact, just $1.3 billion in long-term liabilities and another $900 million in short-term liabilities. So you have nearly twice as much cash and short-term investments than you have total liabilities over at Shopify. So this is a company from a balance sheet perspective looking phenomenal. They don't have a ton of loans or debt on their balance sheet that they're paying a lot of interest on. That's something good to see. This is an asset-light business. I think one that bodes well for this company. The fact that they sold off their logistics business as well, I think proving to be a good sign. They're really not Amazon, and they really shouldn't try to be. And so selling off that logistics business, in my opinion, probably a good thing over at Shopify, lightening their balance sheet up even further. From a cash flow perspective, we have that $273 million net loss in this most recent quarter. Last year, you were at a small net income of $70 million. You get to add that back on your statement of cash flows, and you get to operating cash flows of right around $238 million, far, far higher than same time last year at $100 million. Now, we did speak about stock-based compensation at the top of the show, and this company guiding for $120 million in stock-based compensation for the upcoming quarter. You see in this most recent quarter, they came in at $105 million. And so that is expected to increase, at least on a sequential basis. But you see year over year, that did decline pretty substantially, close to 35%. And so this company, at least cutting down the cost from a stock-based compensation, certainly in my opinion, good to see, considering the fact that you don't have a lot of net income. In fact, in this most recent quarter, you printed a net loss. And so stock-based compensation remains a big expense for this company, and you certainly wouldn't want to see that tick back up substantially over the coming quarters. Now, like we said, from the start, this company a very asset-light business as they spent just $6 million on the purchase of property and equipment. That's their capex for the most recent quarter. And so you have nearly $230 million of free cash flow from this $240 million of operating cash flows. So this company asset light and is continuing to stay that way. You have a lot of your operating dollars turning into free cash flow. And so even if you annualize that, you're looking at roughly $1 billion in free cash flow. That's for the full year. And keep in mind, you're still looking at roughly a $75 billion market cap. So you're paying close to 75 times a free cash flow multiple for this year. So despite the large drawdown, this company not cheap from a valuation perspective. And that's really what we keep coming back to, is the valuation on Shopify still looking quite large. Other than that, this company not really having a ton of use for that free cash flow. And so they get to add that back onto their balance sheet. At some point, maybe can look to do small tuck-in acquisitions. At least right now, I think they're still in a good position where they can continue to add that cash onto their balance sheet. So all things considered, you do like the growth you see over at Shopify, strong top-line growth of nearly 30% on an organic basis, and then strong earnings growth, at least when you strip out that one-time expense. And then on top of that, you are continuing to grow your free cash flow margins, as that is expected to come at nearly 12% for the upcoming quarter. And so you have those fundamentals to like over at Shopify. What you don't like is the valuation and the technicals, as this one has broken through a key level of support and really gapped down and had that momentum continue to have shares slide over the subsequent days. And so you had this uptrending trend line, and Shopify decisively breaking down from that over the past few days. Looks like this one is coming back to test close to $57 a share. This is the part where we highlighted roughly 2 months ago, where between $51 to $58, $57 a share, this would be an area where it would make sense, to be honest, as a long-term buy and hold investor, to at least inch into shares of Shopify. Certainly not saying to unload a full position, even at these levels, because you're still looking at a pretty large valuation, but another, call it 10 to 20% drawdown, and you're looking at a forward multiple, I'd say in the 45s to 50s, and that certainly for the growth you're getting, not a bad deal over at Shopify, certainly if you have a long-term outlook. Now, you do have to consider this company has gapped up in their prior earnings, and so you have a large gap between this 48, call it, up to $58 a share. And so if Shopify does come in and break this $57, $58 a share support, there's a high probability you're coming in and filling this gap over the next, call it, few weeks. And so really the buy zone, I would update that to be somewhere between $46 up to $58 a share. And that really is the updated range where I would say buying shares of Shopify, again, from a long-term perspective, would make sense. At this $57 a share level, I wouldn't be overly excited to open a position. Certainly this is, I would consider, the high end of the range. But as you come down closer to the middle of this channel at $51 a share, that is really where I would get far more aggressive. And then at $46, that you have a long-term support at that point. And if Shopify can come down to those levels, certainly would be far more compelling. And so within this red box, that is my buy zone for shares of Shopify. Certainly if you can get it closer to the low end of the 50s, I think that is where you start being more aggressive in your buys of shares of Shopify. Certainly not a bad company from a long-term perspective. We just took a look at the fundamentals. Everything is staying in line, but there's really nothing in these financials that tells me that shares of Shopify will suddenly rally from $59, $60 a share all the way back up to $70, $80, even $90 a share. There's simply nothing in these financials that tells me shares of Shopify will do that. And so you don't have the urgency to rush in and unload a full position at this point. I think you can be far more patient with a stock like this. Let it come down to levels where it makes more sense from a technical and valuation perspective, because I would much rather miss the train on an expensive stock than be stuck at levels where I'm down 20, 30%. And certainly I don't want to be back here in 3 months and realize if I was just a little bit more patient with a stock like Shopify, I could have gotten it in the range where I first outlined it would be a decent buy. That was my take on shares of Shopify. I think one you have to be a little bit more patient with. This one has come down substantially, but I think another 10 to 20% drawdown, and this one will be far, far more compelling from a valuation and growth perspective. That was my take on shares of Shopify. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.